It looks like there's some AI notes being added.
I thought I just declined that. Let me see. Oh, hello, everyone. Yep, remove. Okay. All right, now we're ready. All right, good afternoon, everyone, and thank you all for joining us for today's month of service presentation. We're here today to talk about foreclosures for mortgages, home equity loans, and reverse mortgages. My name is Nia Murray. I am the programs coordinator for Neighborhood Recovery Community Development Corporation, and we are one of the partners in the month of service collaboration. Also included is the City of Houston's Department of Neighborhoods. And joining us on behalf of our presenting partner with Lone Star Legal Aid, we have presenting today Ms. Samantha Guzman and Ms. Lauren Masulo, who's going to be providing the information for you today about foreclosure and the various mortgage foreclosures that are out there. In addition to us, we also have the Harris Central Appraisal District, the Harris County Tax Assessor Collector's Office, the Earl Carl Institute, Texas Legal Services Center, as well as Houston Volunteer Lawyers, and we all make up a month of service. And basically, a month of service is the collaboration of all 8 of our organizations coming together on a monthly basis, offering a variety of different workshops, resources, and information to the community relative to asset protection, asset building, and the maintaining of generational wealth and community empowerment. We know that there are a lot of underserved communities that are out there. And we try to do our best to put forth the effort to make sure that we get as much information out to the communities that we all serve. So several years ago, we came together and decided to collaborate to try to create a larger impact and reach more people. And in fact, um, the fact that we've had to convert to the virtual platform has indeed allowed us to reach even more people throughout the city, throughout surrounding counties, and across the state of Texas. So regardless of where you're joining us from today, know that the information that you do receive is relative to the laws for the entire state of Texas. It is not just for the city of Houston or for Harris County. Also, do note that the information that you do get here today is to be considered educational, is for educational purposes only. It's not to be considered legal advice or a substitute for you reaching out to talk to an attorney about your particular situation. So, however, this is your opportunity that you can ask questions of the legal service professionals that are in this area. But we do ask that you try to keep your questions to be general in nature so that your personal detail information is not kind of getting out there for everybody to have access to. In addition to that, there's, you're in a group setting, so we don't want people kind of knowing all the details or the nuances about your particular situation. However, we do encourage you to reach out again to our legal service partners to apply for their services. And then they'll go into a little bit more detail about the services that are available for you at Lone Star Legal Aid. Also note that we are recording this session as well as broadcasting live on our social media platform. So keep that in mind as well as you're asking questions. Feel free to type your question into the chat, or you can wait until the end of the presentation and unmute yourself or raise your hand and we can call on you, and then you can ask your questions of the presenters there as well. If you are joining us on social media, feel free to type your question into the comment section and I will make sure that your question is addressed at the end as well. I know when some of you registered, I do have a couple of questions that were emailed to me in advance, and I'll make sure that those are addressed as well and answered for you. So we will be sending out a link of this recording along with the available resources that are mentioned throughout this presentation, as well as the links for our legal service partners so that you could reach out to them as well to apply for service if you do find yourself in need of any civil legal assistance. So do know that that those resources will be made available to you all as well. With that being said, we have a lot of information that we're going to cover here today. Note that earlier this month, we also had a reverse mortgage presentation with Sherry Young with Credit Coalition, who is a HUD certified reverse mortgage counselor, who presented a lot of information about reverse mortgages and how they work, how do you apply for them, and so on and so forth. So this is kind of like why we did that one in the beginning, because I knew we had this one coming up this for this month. So our foreclosure series is actually kind of broken down into three different parts. So last month was the property tax foreclosure. This month is mortgage foreclosures. Next month is going to be HOA foreclosures, and then we start them over again on a cycle, on a rotating basis throughout the year. So know that if you have questions about property tax foreclosures, or someone in one of our other previous workshops had questions about HOA and HOA foreclosures and penalties. So I invited her to come back to next month's session so that she can get information about that. So we do definitely invite you guys to come back and join us for that. If you are interested or have questions about property tax foreclosure, then please just reach out to me and let me know, and I'll be more than happy to send you all the link for that recording and the resources that went along with that presentation from last month as well. So do keep that in mind. With that being said, we're going to go ahead into introductions and get started. So we want to welcome you all and thank you all again for joining us, and hope that you all get the information that you came to receive today. And we do hope that you find the information beneficial, and ask that you share it with somebody else who may also find the information to be beneficial. So Sam and Ms. Lauren, would you guys like to go ahead and introduce yourself, and then we can get on into the presentation?
So my name is Samantha Guzman, and I am a paralegal in the foreclosure prevention unit at Lone Star Legal Aid. Lauren?
Oh, yes. Hi, I'm Lauren Matsulo Martin. I'm an attorney in the foreclosure prevention project at Lone Star Legal Aid. I've been here in this unit about 6 years, at the firm about 8 years, and we're very grateful for this partnership to be able to present this information.
Okay.
So I'll share my screen. Hmm. So again, today's topic is going to be about mortgage foreclosures. Again, today's presentation provides legal information only. This is not legal advice. We cannot tell you what type of mortgage loan or loss mitigation option is best for you. Please consult your financial or tax advisor and lawyer for advice regarding your own personal situation. Our agenda today is I'm going to give you a brief introduction about Lone Star Legal Aid and our services that we provide. Then we'll get into mortgage foreclosures generally, followed by loss mitigation, and then we'll round it out with specific mortgages, followed by our Q&A at the end. So if you have any questions, please feel free to save them to the end or type them in the chat, and we'll get to them as we go along. And again, I'd like to remind you to not give your personal details. Let's keep it general informational questions only. So here at Lone Star Legal Aid, we protect and advance the civil legal rights of the millions of Texans living in poverty. Lone Star Legal Aid serves 76 counties by providing free advocacy, legal representation, and community education that ensures equal access to justice. Some fast facts about Lone Star Legal Aid. Again, we do service 76 counties, with 72 being in the Eastern and Gulf Coast regions of Texas. And we also have 4 counties in Southwest Arkansas. Our service reaches approximately 60,000 square miles of Texas. We do have 14 offices. We'll get a little into that a little further into the slides, but our main office is here in Houston, in downtown Houston. Um, we have, there are approximately 1.9 million people that live at the 125% of federal poverty guidelines who are eligible for our services. In 2024, we assisted 61,289 individuals by working on 25,111 cases. Among these individuals that we helped, 7% were veterans, 32% were domestic violence survivors, and 18.5% were senior citizens. So who do we help here at Lone Star Legal Aid? We help children's, veterans, seniors, the LGBTQIA plus community, people with disabilities, and our homeless population. Majority of our clients are women, most of whom are mothers, and many of our clients face isolation due to limited literacy, living in rural areas and remote locations and also have language barriers. More than 1.5 million people in our service region speak a language other than English, and here at Lone Star Legal Aid, we do have services uh, where we'll be able to help to speak with those who don't speak English, who speak another language. Excuse me. In Texas, there's roughly one attorney for every 380 people in the general population. However, for low income people, there's one legal aid attorney for approximately every 17,000 people with income at or below 125% of the federal poverty limit. With limited access to modern mass communication media, which includes telephones, computers, internet, cable TV, is common among our client community, and there is little or no public transportation in most of the rural areas we serve. Again, our mission at Lone Star Legal Aid is to protect and advance the civil legal rights of the millions of Texans living in poverty by providing free advocacy, legal representation, and community education that ensures the equal access to justice. So for our eligibility, and if you have questions about our eligibility, we can get into that in our Q&A as well. We help people living in the 76 counties we serve. We only work on criminal cases, and we do not handle we only work on civil cases, I'm sorry, and we do not handle criminal cases, nor do we handle personal injury cases as well. We only help those who are low income. So some general law types that we work with here at Lone Star Legal Aid, we do consumer law, employment law, family, healthcare, housing issues, juvenile issues, neighborhood problems, public education, and financial assistance and public benefits. So some special projects that we have here at Lone Star Legal Aid is we do have a unit that specializes in civil matters and criminal justice. We have a community advocacy unit, a crime victims unit. We do work with disaster reliefs. I know hurricane season is about to start, so we do help navigate that FEMA process at times. We have an environmental justice project, low income taxpayer unit, a medical legal partnership. We also have a legal assistance to survivors of sexual assault. We have an eviction right to counsel, so we're still working with a bunch of eviction cases throughout Houston and our other 75 counties. We have a fair housing unit and a military and veterans unit, as well as our foreclosure prevention project, which Ms. Lauren and I are a part of. So how do you ask for help here at Lone Star Legal Aid? Well, you can go online to www.lonestarlegal.org 7 days a week, 24 hours a day. And if you don't have access to the internet, you can give us a call at 1-800-733-8394, Monday through Friday during regular business hours. And I'd also like to note that our Houston office is now accepting walk-ins between 8 and 4 p.m. Monday through Friday. If you don't have access to the phone or an internet, you can come into our office and submit an application with us. So I mentioned that we do have branch offices here, and so we're going to talk about those. We have an office in Beaumont, Belton, Bryan, Clute, Conroe, Galveston, Houston, Longview, Nacogdoches, Paris, Texarkana, Tyler, Richmond, and Waco. You can also follow us on social media. Our handle for Instagram is at Lone Star Legal Aid. For Facebook, it's also at Lone Star Legal Aid. And for YouTube, it's also at Lone Star Legal Aid. So you want to follow us for some vital information that our community communications unit puts out every day. They have good information about our upcoming outreaches, as well as some interesting stories about clients that we have successfully assisted, as well as important information that might be helpful for you regarding legal issues that we've come across. So go ahead and give us a follow. And so I guess we're going to jump right into it. So, Lauren?
Okay, thank you so much, Sam, for telling us all about our services here. So next, we're going to get into the topic of discussion for today, which is mortgages. We're going to start with kind of a 101, an overview, so everybody has basic working definitions and ideas, and then we'll go into more about, the foreclosure process, some specific types of mortgages. So the first thing is we're just going to mention that there are certain types of mortgages. The typical one that people might think of is the forward or purchase money mortgage. You say, I'm going to buy a house and I'm going to get a loan, and you maybe put some money down and then you get a mortgage for the remaining amount that you pay over, 30 plus years. That's the typical one people think of. But as Ms. Nia mentioned, there's also a reverse mortgage, which we'll talk about briefly, and then there's a wonderful full presentation on that was recorded previously. We also see other types of mortgages. One is a special one called a partial claim. It's a specific type of second mortgage that sometimes comes up when somebody had been behind on their primary mortgage. We see home equity loans and home equity lines of credit. We'll mention those. We have a segment today on executory contracts. Those are you might hear them called contract for deed or land sale contracts or something like that, where you're maybe buying from a private party. And another thing we've started to see something called zombie second mortgages, we've called them that, where they kind of appear out of the blue. Many people in the past took out two mortgages, one for the down payment and one for the primary long-term amount. And then those second ones that they think they've handled sometimes come back and appear. So we've seen all these different types of mortgages come through our desk. Just some basic terminology. So a mortgage places what's called a lien on the borrower's home, and the lien is basically a obligation to pay a debt. So I'm going to take out a mortgage for $100,000. I'm going to pay it off at $800 a month, and I have that obligation. And if you don't meet that obligation, then it's a secured debt, or there's a thing that the lender can get their money back on, and that is the house. And the way they do that is they can foreclose on the house. And if you suffer a foreclosure, oftentimes the home sells for, at a minimum, they're going to try and clear up how much is due on the loan. And so it may sell for less than the total value it would have sold on the market. And so you can lose equity. You can lose that extra amount that it could have sold for on the market. So as we'll talk about, ways people get foreclosed and what the graceful exit options might even be selling the home to avoid that foreclosure. So who are the main players? We're going to focus on two to, again, getting in that vocabulary. The first player or entity you might hear about in the mortgage context might be called an owner or an investor or an insurer. It's the entity that finances or backs the loan, who ultimately are the mortgage payments owed to. And when we get into loss mitigation, which is the process of getting back in good graces, getting caught up on your mortgage, what can you do when you're behind? This owner, investor, they're the one that determines what options are available to you. Oftentimes, in studies show about the majority of times, the entity that's backing the loan is a federal entity. It could be Fannie Mae or Freddie Mac or Ginnie Mae. They're called government-sponsored enterprises, or GSEs, or the Federal Housing Administration, the Veterans Administration, the Rural Services, are part of USDA. So they're either a federal entity or they are federally backed in some way. But sometimes it could also be a private entity that is not federally backed. There are still many mortgages that way. You might hear them called private label securities, loans held in portfolio. All of this other catch-all might be the ones that aren't federally related. And then the next one is the loan servicer. That's what the agent of the owner, investor, or insurer. So that is the entity that investor hires to go ahead and interact with the borrower. That's what many people say when they reference their mortgage company. That's whose logo is on the mortgage statements. That's who they pay the mortgage to. That's who they talk to if they want to get out of a default or catch up on their mortgage. That's the entity that pays the taxes and insurance from your escrow. And that's who you work with as a regular basis. But keep in mind, many times on the back end, there's a different entity that's actually the investor who the mortgage is owed to. And just some notes. So these investors can sell the property from sell the loan from one to another. They pick the loan servicer and they can change those as well. So you may get letters in the mail periodically, especially when your servicer changes, saying you used to send your payments to company A, and now effective this date, you send them to company B. And so always watch for those letters. If you have auto drafts or whatever, you may have to enroll in a new process. But those things can change and you really don't have a choice. And again, occasionally it's the same entity, but oftentimes the investor and servicer are different. And now we'll talk more about the foreclosure process generally in Texas. So when is somebody risking foreclosure when they have a mortgage on their home? Primary reason is when they are in it, or what occurs when they are in default on their mortgage. That's the industry term, and it means somebody hasn't kept up with the terms of their mortgage. It's often because they haven't paid their mortgage payment, but it could also be that they haven't maintained their homeowner's insurance, haven't paid their property taxes, something along those lines. And again, the loss mitigation process that we'll define in a little bit is what they can do to try and get caught up to avoid that foreclosure. So what are some reasons that people default? High cost loans, especially if they took out a loan with a higher variable interest rate. They maybe lose job, go through a divorce, somebody passes away, income changes, and now they have a mortgage that is higher than they could used to be able to afford. Maybe they have increased in medical expenses or injury. Maybe a misunderstanding about their need to pay property taxes and homeowners insurance separately on a reverse mortgage. We'll talk about that. Another thing we've frequently seen is the mortgage payment goes up a lot because of increases in the escrow as property tax costs, insurance costs go up over time. That becomes part of your monthly mortgage payment and that increases too. So those are some reasons people might get in default. Mortgage foreclosure generally. So Texas is what is called a non-judicial foreclosure state. So the word judicial, it's kind of referring to judge or court. So non-judicial means there are many times when no judge or court is required, no lawsuit. Foreclosures in Texas are held on the first Tuesday of every month. If the Tuesday happens to fall on January 1st or 4th of July, it'll be Wednesday, but otherwise it's the first Tuesday of the month. Under federal law, a loan servicer cannot send the first foreclosure notice or the first foreclosure act until at least being 120 days, so 4 months behind. But once you get to that point, a loan servicer then just needs to send the borrower a notice of default that gives them at least 20 days to fix the default. It's sent by certified mail. And so they give them 20 days to fix this problem. And then if they haven't, then the loan servicer is allowed to do what's called accelerate or make the whole loan due. So if before you were $5,000 in arrears because you'd missed a few months, now the loan servicer can make the whole $100,000 loan due. And then they may have to file a lawsuit, but often in Texas they don't. And then they just have to give a 21-day notice, so a second notice saying that they're going to foreclose on a certain date. One thing to note, if you are foreclosed on, the buyer can't remove you without filing an eviction suit. So it's not that very day that you have to be out on the street, but it is a very quick process that you might be moved along if there's been a foreclosure. Judicial foreclosure occurs when the terms of the mortgage require a lawsuit. So we see those with certain circumstances for a reverse mortgage, certain types of defaults. in the, certain situations, but sometimes those lawsuits even are expedited, which means they are intended to go more quickly than a typical mortgage foreclosure or typical lawsuit. It's generally required, again, with reverse mortgages and a few other circumstances, home equity loans and so forth. Again, just a 21-day notice is required after the judge signs the order allowing the foreclosure. They don't even have to prove that you got that letter, just that they sent it. And let's see. There it goes. And again, non-judicial, they just have to send that 20-day notice, 21-day notice, and move right along. So that is a much faster process. One thing we note, foreclosure scams, we want to mention this here. So when somebody files a foreclosure lawsuit, or when somebody's file, and every time a 21-day a notice of foreclosure sale is issued, it is recorded in the county clerk's records. So scammers can find that information and they will start contacting people, trying to get them to sell the property or claiming that they are able to magically save you, sometimes for a fee. So don't let yourself be pressured, or anyone you know who's facing foreclosure. The Federal Trade Commission has an article about that as well. You can contact the HUD housing counselor, which we'll have contact information for later, or Lone Star, but just be prepared to know that someone might get contacted if they're at risk of foreclosure from scammers. Some examples are phony counseling. So the scammer might pretend to be a housing counselor, saying they'll negotiate for a fee. They'll help you submit a loss mitigation application for a fee, which is free of charge otherwise. They'll make you pay to the scammer rather than the victim. I mean, rather than the mortgage company. Sometimes they'll claim, "Hey, give me the deed. I'll, rent to own for me for a while, and you'll get your house back." Or they'll say, "Hey, pay to me, but it's very, pennies on the dollar, but go ahead and sell me the home and I'll fix it from there." So these are all scams. And now we're talking about loss mitigation. Let me see, I have a question. Is the foreclosure process the same for VA-backed home loans? Yes, there is the same. The loss mitigation process may be different, which we're about to talk about, but ultimately when you get to foreclosure, it's those same steps. Let's see here. Okay, so you're working with your loan servicer to avoid foreclosure after you have defaulted on your loan, again, done something that makes you not in compliance with the terms of the mortgage contract. There are two main buckets of loss mitigation. The one is the home retention. What can you do to try and keep your home? And the other one is the graceful exit or non-home retention, when you're saying, well, I at least don't want to go through the foreclosure process. I want to keep the equity or do something like that. What can I do to at least get out of the foreclosure process? Maybe even get a little relocation funds or something. So those are the two main buckets of loss mitigation. The home retention options. So your options that are available will vary based on a number of different things. Like we mentioned before, it'll matter what the investor allows. For those federally backed mortgages or federally related mortgages, there's actually rules and regulations that determine what they can offer. And then the private ones kind of have their own things. But the options may include one or more of the following solutions. So reinstatement, that could be where, hey, I can afford to pay the whole arrears now. I have a family member that's going to help, or I've got my job back. I just want to pay everything that's owed and then keep going from there. Another part might be a forbearance. I'm in a temporary challenging situation. Can I be given, grace to not pay for a little while and then pick back up? But then you're going to have to deal with that arrears balance, usually through one of these other methods. But at least you're not considered in default if they've approved this forbearance. A repayment plan. So they may say, hey, if you can pay your monthly typical mortgage payment, plus we could break up the past due amount you haven't paid over the last few months into an additional amount for the next year or so. They may agree to that. A loan modification, that might be where the terms of the whole loan change. So you go through kind of a review process and maybe they change the interest rate or they change how long you're going to pay. They re-extend the loan, but something that changes the whole loan contract. The FHA has a special program called partial claim where they kind of just take the arrears and stick it at the end as a loan. Some other mortgages will do a deferred balance at the end of the loan. And then the reverse mortgages even have additional options that might be available. Now, one special category of people that we see in our practice often that have specific issues with loss mitigation are called successors in interest. So not only is there a problem with the mortgage, but people who are successors in interest have basically inherited the home or an interest in the home for some reason. It usually occurs if they are either the borrower has passed away and they're an heir, or maybe they've gone through a divorce. And the issue is the non-borrowers who now are living in the home, responsible for mortgage payments, the mortgage servicer won't communicate with them because they're not the one they have a contract with. They're not the one on the mortgage. So first you inform the mortgage company you exist and they identify you as a person who would have an interest, but you have to be what's called confirmed or, turn in paperwork so they can prove you are entitled to have a title interest in the home and they can talk with you. And that means you have to turn in paperwork. And that's often where we kind of get involved because sometimes they're asking for really complicated paperwork, like insisting an estate went through probate, where there might be just documents that we can provide, like affidavits and such. The law actually requires it to be reasonable for the jurisdiction, whatever paperwork Texas would otherwise take to prove that you had a title interest. So what are some typical problems that you might encounter if you've inherited a home? Again, can't communicate with the loan servicer. We see people who sometimes they're not getting the appropriate monthly statements or notices. We've seen times when they're not named on the homeowner's insurance as because it's still in the name of the prior borrower. We've seen times when the servicer has revoked the website access so they can't even log in anymore to see what's going on. Again, they get behind or what have you, and the mortgage servicer won't give them those loss mitigation options, won't let them to do a forbearance or a loan modification. Sometimes, especially if in divorce situations, the servicer will still insist that an ex-spouse sign off. That's often a time we get involved as well because there may be special rules that can get them around on that. And the whole process can just be plain confusing to try and navigate. And while we're talking about successors in interest, we wanted to spotlight a specific issue, which is heir property ownership and tangled title. So successors are often heir property owners, which again occurs when the property owner passed away and perhaps either many generations or even just one generation of homeowners don't resolve the estate of the record owner. So the deed records say a certain person passed away, mom owned the property, mom passed away, and now perhaps her children are her heirs, and they haven't done anything to clear up with the rest of the world with the public records showing that they actually are now the owners. So the title passes under Texas law, or maybe they even had a will, but it left the property to numerous people, like all of my children or whatever. And now there is confusion about who owns it, or many people own the property together. again, these successors can face these challenges that we just discussed with the mortgages. They have problems when the heirs want to sell the home, or they want to get a home equity loan, or they want to get home repair assistance. They have rights. You have rights if you've inherited a home, but sometimes the paperwork is confusing, and that's another time that we often help here at Lone Star Legal Aid navigating those problems. We often see people facing tax foreclosure. Um, uh, AMOS here has wonderful presentations from the tax office and the appraisal district about what your rights are when you need to pay your taxes. But sometimes heirs don't realize that there's paperwork they can and need to fill out in order to access those rights. We often help them with that here. And Texas law has even become more become easier to access those exemptions and those deferrals, the right to hold off on paying your taxes under certain circumstances, but you have to fill out certain paperwork. So basically, there's just additional steps for these heirs, and our office works with a lot of people trying to help navigate those issues. So back to mortgages, we've talked about some basic terms related to mortgages. We've talked about what is loss mitigation and what are we going to do to fix that problem. So loss mitigation is a type of loan servicing. We talked about mortgage servicers, servicers being the entities that you interact with. And when they're not doing things right, when they're not letting you prove that you're a successor in interest, or they're not letting you set up a modification or whatever's needed, then they're making an error, arguably. And so, what are some options? One option that you might start with is what we call escalating, make complaints. Contact your loan servicer, and if you're talking to the frontline representative, ask for management. Talk with the main entity that backs the loan. If it's Fannie Mae or Freddie Mac, we have numbers on the screen. FHA, they have a servicing center. You might be able to contact the Attorney General's Consumer Protection Unit, credit commissioner, and so forth to see if they can help with the situation. Another right that you have is to write a letter to your loan servicer telling them that they have done something wrong, or asking them for information so that you can figure out what's going on. It's called a notice of request for information or notice of error. You might see the term QWR, qualified written request. Now, if you look at all the fine print on your mortgage statement, it often it should have in somewhere a letter that says for notices of error, request for information, or for NOE, RFI, QWR, one of these terms of art, contact this address. And you have to you have the Real Estate Settlement Procedures Act is what's protecting you, giving you this right, but you do have to send it to the designated address. And you can use these types of letters. You're basically contacting the loan servicer in writing, making sure you put the information on your letter that identifies you, and the loan. So this is my name, this is the address, this is the loan number. You're writing to the mortgage company, and then you're asking the information or telling them what's wrong. You're stating, I need a copy of my mortgage statement, or I think you haven't applied my mortgage payments correctly. Please investigate this and get back with me. They are required to actually do a reasonable investigation of your concern or your question or your complaint. They're supposed to send you a letter saying that they've received your correspondence, and then they get 30 days to do a full substantive response, and that doesn't count weekends or holidays. So math-wise, it might be more like 45 days. So if you have an urgent situation, you probably need to be calling them and doing all the informal things, and then also sending this letter. But the letter, they get a little more time to respond. They can also ask for or just tell you that they're giving you they need 15 days in addition. But this is a good way to get things on the radar and get them in writing, get a response in writing that the loan servicer has investigated. And writing these letters, we have a tool. So you can go to lonestarlegal.org, our website, and click on our resource library, indicated here by the arrow. And then you can go scroll through the topics and select the foreclosure topic, and it'll say there'll be an option that says get help if you can't pay your mortgage. A2J means access to justice, self-help tool. You can click on that and it will help. One of the services it will offer is to help guide you through writing one of these letters to send to your mortgage company. And then briefly, we're getting into the section now on some specific types of loans. So what are home equity loans? First of all, what is home equity? Home equity is the amount of money that your property is worth minus any existing mortgage or other liens on the property. So we talked about liens meaning you owed something, so it might be property taxes, for example. If you hadn't paid those, that's a lien, or if you haven't paid your HOA, what have you. So for example, if your home is valued at $100,000 and you have $75,000 remaining on a mortgage, no other liens, then you have $25,000 of home equity. And this is what we were kind of referring to earlier when we said you can lose this in a foreclosure. So if you owe $75,000 on the mortgage, that's all the mortgage company is going to try and sell the home for. If you sold it on the market, hopefully you could recoup that extra that you would be that the home is worth. And in a foreclosure, that's less likely to happen. Home equity loans allow you to borrow money using the equity in your home. So that extra 25,000, is there a way to tap into it? They usually have, they're a fixed interest rate, fixed end loan. You usually receive a lump sum up front or during an initial period, and then over time you pay that back like a regular mortgage. You can use the money for home repairs or other needs. If you already have a mortgage, this is a second mortgage. But just like any other mortgage, if you default on a home equity loan by not paying, they can foreclose. And then a line of credit is home equity line of credit, similar concept, but it has a time when you can make a draw period or a beginning period where you can borrow and then and make minimum payments if you choose, but after that initial time, you can't borrow any more money. And then you enter into a repayment period where you have to make payments on the money you withdrew. You can kind of go back and forth getting funds in the beginning, but after a certain period, you're only in repayment. Sometimes you'll wind up with what's called a balloon payment because those monthly payments during repayment may end up not quite meeting the total amount that is owed, and then you owe a big amount at the end, and then you either have to pay it off or refinance that. It can also have adjustable interest rates, so the amount that you are paying can increase, and you don't have that protection of the fixed interest rate like other mortgages. Again, they can foreclose if you have not made your payments. And then these reverse mortgages that we've talked about. Again, this is going to be an introductory overview. AMOS had an amazing presentation about a week ago that's recorded. That's the entire length of one of their sessions, going into a deeper dive. But a reverse mortgage is a special type of home equity loan. So it's a home equity conversion mortgage, or HECM. You might hear those acronyms. It's only for those who are 62 or older. And the difference here is they don't have any personal liability to repay the loan. So let's say the loan is for a certain amount to repair your home or to pay back taxes. Unlike entering into that repayment period, you're not repaying that amount during your lifetime. The security is the house only. During your lifetime, you can live in the house. However, you have to continue to pay your property taxes if you have any HOA fees, and you have to keep homeowners insurance. And there is a confusion sometimes there because people typically pay when they have a mortgage, their taxes and insurance as part of their escrow. So they're not personally taking the time to write a check to the taxing unit or their insurance company. It's just all part of their mortgage. And when you're not paying a monthly mortgage payment with escrow, you have to yourself on the side keep track of those payment of property taxes, keep track of making sure you pay your insurance. Borrowers must have equity in the home to qualify for a home equity conversion mortgage. There's a very specific process for the lenders to determine if you have enough equity in your home for them to be willing to lend to you. And your home also has to meet certain maintenance standards, or they may require that you use part of the loan to repair the home before, in order to take out the loan. A reverse mortgage is the opposite of a regular mortgage in that the balance grows over time. So there's interest and fees and so forth that over time increase. Whereas a regular mortgage, because you're making monthly payments, over time it decreases until it's paid off. Sometimes the loan balance even grows higher than the value of the house. Sometimes then it gets reassigned, or the investor decides to assign that loan to HUD, so your investor changes. The loan balance becomes due when the borrower sells the home. That's true of any other mortgage, but there's these additional requirements. You have to occupy the home as your permanent homestead, and if the borrower no longer occupies the home for more than 12 months without getting permission from the lender, the loan balance becomes due and they can foreclose. You actually have to fill out an annual occupancy certificate, a form every year, attesting that you're still living in the home. Another time when the loan balance comes due is when the last surviving borrower dies. So if a husband and wife took out the mortgage, one passes away, they allow just the other one to continue being the borrower on the loan, but then when that person passes away, the loan becomes due. This becomes an issue for heirs that we'll talk about in a little bit. And then, of course, like any other mortgage, if the borrower defaults on the terms of the mortgage, so things like not paying those taxes or fees, HOAs, or keeping insurance, like we mentioned before. So heirs, when they inherit a home by will or by operation of law that had a reverse mortgage on it, those heirs have to, unless they're a surviving spouse, and we'll talk about that in a bit, but all the other heirs, if they're the children or whomever, they either have to pay off the loan balance some way by refinancing it or paying it cash in order to keep the home. Otherwise, they would likely have to sell it in order to avoid that foreclosure. If the loan if they want to sell, then they may have to go through some kind of probate process or sort out titles so that the heirs can sell. So what are some benefits and risks of reverse mortgages? So the benefit is that you can receive this money either upfront or as a line of credit. You can use that money if you need cash, if you need to make home repairs, pay off debts, pay off an existing mortgage. Maybe you have not much owed and you don't want to make those payments anymore. You can pay off an old mortgage. Or maybe if you owe a lot of taxes and you want to get those paid off, maybe you don't qualify, you're 62, but you're not yet 65, and you don't qualify for the deferral yet, or what have you. You have emergency funds. Something happens and you need a large figure, you can get funds up front for an emergency. You can supplement your finances that way. You can live in the home and still access its equity without selling it. And it can work best if you either don't intend to leave the home to heirs, or if you know that your heirs or your estate will be able to pay off that loan at the end. But here are some risks. And of course, when we see more reverse mortgages, it's often when somebody's encountered or is dealing with one of these risks, these problems. So first of all, you may think that you can get one and you don't qualify. Both spouses now have to be age 62 or older. There were times in the past we'll talk about when only one spouse might have been old enough, but now it's both have to be at 62 or older. And maybe there's too many liens or the property's in too poor condition. So you won't be able to get the loan for that reason. Also, just like any other mortgage, you can't defer your property taxes. So AMOS has great presentations with much more detail, but if you're 65 or older or disabled and don't have a mortgage, you can put off your property tax payments under Texas law. But once you have a mortgage of any kind, including a reverse mortgage, you have to go back to paying those. And again, you can be foreclosed on for any of the reasons that we talked about. You can't leave the property to the heirs easily. If there were a non-borrowing spouse on the loan from a long time ago, they're at risk of foreclosure. And again, the loan balance continues to grow. But you do have loss mitigation rights if you have a reverse mortgage. So just to put, like we talked about before with regular mortgages, how you might qualify for a forbearance or a modification, there are different types of loss mitigation options available. What we're talking about today are FHA-backed reverse mortgages. So almost all of the reverse mortgages are federally backed. There are a few private ones, and those will have, their own rules. But the ones we're talking about today are the vast majority, which are the federally backed mortgages. One option is a repayment plan. So the mortgage company just lets you pay off what's in arrears. You didn't pay the taxes. What will happen, for example, the mortgage company will pay them, and now you owe the mortgage company, not the taxing unit. So now, even though you don't have a typical monthly mortgage payment, you do have to make a payment to the mortgage company, but it's to pay them back for taxes or to pay them back for insurance. They now can give you up to a certain length of time to pay that back. Up to 60 months, and they're actually trying to get even more than 60 advocates are, but at least now you get up to 5 years to make those payments. They'll even allow you to pay if it's up to $5,000 owed. But not everyone will qualify because they do go through an analysis of your income and expenses and how much is owed to see if they will actually extend you this offer to just repay whatever you got behind on. Then there's things called informal delay, where the lender just informally allows you to kind of pay back as soon as you can, and reinstatement. You have the right, even if they have accelerated the loan, meaning made the whole thing due because you were in default. They sent you that 20-day notice to get caught up. You still didn't get caught up. They accelerated the loan. These FHA backed reverse mortgages give you the absolute right once every 2 years to deaccelerate the loan and get back in good standing if you're able to engage in one of these options. Keep in mind, there'll still at this point be attorney's fees and costs added to the loan balance. You can also have, this is one special rule for those who are at least 80 years old. So if you have a reverse mortgage and the youngest borrower is at least 80 years old, so both spouses, and there's critical medical circumstances that would become worse if a foreclosure occurred, you can essentially get the chance to try a repayment plan, and either you don't qualify or you default on it, then you get it like a doctor's note, and the mortgage company has to allow you to not be foreclosed on. Again, you have to be 80 or older, the youngest borrower. Used to be you had to recertify every year. Now there's some new authority that makes it seems like you wouldn't have to recertify every year, but be prepared to be getting those doctor's notes. And then there's another special option. Prior to August of 2014, sometimes reverse mortgages were issued to people where one spouse wasn't yet 62. And so the lender just left them off the loan. And then when that older spouse passed away, the one left behind faced foreclosure. And this was a big gap, and litigation ensued. And ultimately now there are options called a mortgagee optional election where this surviving spouse can be allowed to remain in the home. That's often a concept or a circumstance where we have clients come to us because they do have to talk with the mortgage servicer about being given this option. And this is just a example here. Before that August 2014 date, you have to talk with the loan servicer. After that date, if you're a surviving spouse for some reason, they should enter you into this program, but you have to ask. Options for non-borrowing spouse heirs. So as we mentioned earlier, if you inherit the home and you're one of the children or what have you, you have some options. You're given some protection of time to be allowed to resolve the issue of the loan being due, but it does have to be paid off. You're not like a surviving spouse where they can just defer the payment indefinitely until during your lifetime. So those heirs, again, they have to be confirmed as a successor in interest, the thing that we talked about earlier. They'll have to prove that they are an heir. Usually it's turning in their photo ID, turning in the death certificate, turning in something showing they have title, like an affidavit of heirship or a probated will. They are given 2 90-day periods, so basically 6 months of deferment of having to pay off the loan while they're given the time to try and sort out what they're going to do. Are they going to pay it themselves? Are they going to sell? Are they going to use it? Are they old enough and can take out their own reverse mortgage to pay it off? They get that time. They can even get an extension, but they have to, ask for it and qualify. They also have something we actually saw in real life recently. They have the right to sell the home for 95% of the appraised value versus what's owed on the loan. I mentioned earlier that sometimes the loan balance becomes even higher than the value of the home. We actually had one of these come through our office, and they were able to find a buyer because 95% of the appraised value was significantly less than what was owed on the home, and the lender is required to let them sell for that rate so they at least don't get foreclosed on. They can, even maybe get some help moving out of the home with a cash for keys arrangement from the lender, which wouldn't otherwise be available if they didn't have that chance to sell for a little bit less. If you want to learn more, see this all detailed for you, the FHA has a flyer. You can go to hud.gov/answers. We have a specific link to that flyer there. And then what do you do if you don't qualify? So maybe you either can't qualify for a loan modification or don't have the money to pay back your arrears. You're an heir, but you can't pay off the loan. What options do you have? Eligibility will vary, first off, but you may be able to refinance. You may be able to get your own loan. You may be able to file a bankruptcy, Chapter 13, but again, if you qualify, so talk with a bankruptcy attorney to see if you have the ability to save the house that way. Again, you might need to sell the property on the open market just to at least keep that equity. You maybe get the servicer's permission to do what's called a short sale, sell it for less than is owed, kind of like we just described, and or a deed in lieu where you're just signing the deed over to them instead of having to go through the trauma or the foreclosure process. And sometimes those arrangements even allow, again, what's called a cash for keys, where the lender gives you some money to move. Not always, but you can ask. There could be tax implications here, so just talk with a tax attorney if you're getting a lot of the loan forgiven because you're selling it for less. Keep in mind your home is foreclosed. If your home is foreclosed, the new buyer must file an eviction lawsuit under Texas law. They have to take you to Justice of the Peace Court. They have to give you a 3-day notice saying, I've bought your home. You have 3 days to move out. Then if you don't, they have to file an eviction lawsuit. You have the right to appeal if you lose, even if you don't per se have a defense. So you can kind of get yourself some time. But ultimately you would have to move, but at least you don't have to on the very day of the sale. And again, talking to a HUD housing counselor, HUD.gov, these are very knowledgeable people, just like Nia referred to Ms. Sherry, who gave a presentation last week, who can kind of help listen to your circumstances and navigate some ideas about whether or what kind of loan might work for you. Okay, and now thank you for your attention. And now I'm going to pass the presentation back to Sam so that she can talk to you about yet another specific type of mortgage, a contract for deed.
Before we start, oh, we did have a question in the chat. It wanted to know, what was it? It disappeared on me. Here we go.
Okay, was it the VA loan one?
Yes.
Okay, and I see one. So I think I've
It
answered
says,
it, but yeah, go ahead.
is the foreclosure process the same for VA-backed home loans?
Yes, so the loss mitigation process may be different. The VA might offer different types of loss mitigation or ways to get back in good standing. But once you face the foreclosure process, then their 20-day notice, 21-day notice, or the first Tuesday of the month sale, those are the same.
Okay. So we're going to talk about executory contracts. We refer to them here as contracts for deeds. Ooh. Okay. So executory contracts they're a long-term agreement to buy a property. They are different from traditional owner financing. You may hear them called for sale by owner, lease to buy, um, just generally different names, but they are executory contracts. And with an executory contract, I'm going to call it contract for deeds because that executory word is throwing me off. Well, with a contract for deed, the seller actually retains the title to the property, and you as a buyer do not receive the deed to the property at any time at the time of the sale. You will receive your deed at the end of your payment contract plan. You will have to pay a down payment followed by a monthly or periodic payment over time with a minimum of 180 days. The seller will then transfer the deed to buyer when you make your final payment. And again, it is also commonly referred to as contract for deed, land for sale contract, or land sale contract, or installment land contract. Those are some other names. So who buys property using executory contracts? Traditionally, people who don't generally qualify for a traditional mortgage for your home oftentimes use contract for deeds to buy their homes. Those who have low credit scores or recent bankruptcy, or those who cannot get financing from a traditional lender. Also, those buyers who have little or sporadic employment history, and those who have a high personal debt to income ratio. We may also have buyers who have changed their employment situation recently, and buyers who can't afford a large down payment, typical mortgage fees, and closing costs, or those who have insufficient collateral. So, what is so important about these contracts? Well, first and foremost, they are potentially predatory. And because of that, Texas law has now added strict consumer protection laws where the Texas legislature has found that executory contracts for the sale of residential property have long been disfavored because they encumber title without transferring title. They cannot be sold in the real estate market and cannot be used to borrow money to make home improvements and are potentially abusive transactions under which legal title to homestead property may be withheld until many years after the buyer has built a home and made other expensive improvements. Now you may say, what does all of that mean? And we'll discuss that in our next slides. So according to Texas Property Code Chapter 5, Subchapter D, this statute applies to any transaction involving a contract for deed for the conveyance of real property to be used as residence by the purchaser or their family member, where the contract is to be completed in more than 180 days from execution. So again, it applies to you buying a home or property from a private seller, and it has to be completed more than 180 days from the actual signing date. It includes a residential lease agreements with a purchase option, but some consumer protections don't apply as they would to normal traditional mortgage loans. It does not cover contracts with governmental entities or between family members. And a parcel of land measuring 1 acre or less is assumed to be residential. It provides statutory obligations, remedies, and statutory damages for violations, which we'll discuss as well. So there are quite a bit of risks associated with these contract for deeds, because again, it's buy seller to the buyer. So traditionally, you do not become legal owner until all payments are completed. And there are now options for you to get title during the term of the contract, but the buyer has to know about and exercise those rights. So you as a buyer have limited control over the property while under contract, especially if the contract is not recorded. So when you sign your contract for deed, the seller can record that contract in the county clerk's records to show ownership on your part of the property. But they don't often do that at times, and so there's no record of you actually having an ownership interest in the property. However, you can record the contract on your own if it is notarized. If it is not notarized, you can use a signed notarized affidavit of facts. You could then add that to the contract itself and record it within the county. And this is, you can read more about that under Texas Property Code Section 12.001 1B2. Um, we do recommend here that you do make sure that your contract is recorded, and just to protect yourself. Even if they don't do it, they can't stop you from doing, the seller cannot stop you from doing it, but you can do it on your own. Okay. You also, as a buyer, risk losing the property and all money paid toward the property if you default on your payments. The seller can cancel the contract and retake the property, keep all the payments, and benefit from any improvements that you have made. The seller may also not have clear title, even though they are supposed to. So sometimes we've seen this here where somebody's purchased a home using a executory contract, and then in turn realize that the person who sold them the home or property did not actually own the property. So you want to make sure that you have a clear title. So the person who is selling you the home actually is the owner, and you're not tied up in a legal battle because you purchased this property for somebody who didn't even own it. And I also like to mention that your contracts that you sign should also be in your primary language. So if you speak Spanish or another language, you can request that your contract be in your language. Excuse me. And another risk that you do that is possible is that the seller may continue to encumber the property with mortgages and liens, even though that they aren't supposed to. We have seen instances here where the seller maintains the property taxes in their name, and then our homeowner is met with a foreclosure lawsuit for property taxes because the seller failed to pay them. So keep that in mind. You might want to check on those taxes every year to ensure that they're being paid. The seller may also try to evict you, which is a quicker process, rather than foreclose, which is a longer process. So some key protections for yourself is that you have a right to convert the contract, which again is what we discussed earlier. They are required to record the contract, but again, they often do not. We've seen a bunch of those cases as well, where the seller didn't record the contract and the buyer has no idea that they could do it or that it was supposed to be done as well. So they're not protected, and have on paper documented that they do have an interest in the property. You do have an absolute right to convert the contract or recorded legal title at any time without penalty or charges. And the seller has no choice again in the matter so long as the buyer tenders the balance owed under the contract. This is true whether or not the executory contract was recorded. A right to request balance in trustee. So this means that the buyer, which is you, can demand to know the amount owed under the contract and, if applicable, the name and address of the seller's desired foreclosure trustee. If the seller fails to respond within 10 days, the buyer can determine the amount owed and, if applicable, select a trustee. Then the seller has 20 days to contest the amount determined and must send a written objection to the buyer. A seller's objection must be based on written records maintained and regularly updated by the seller. So you do have a right to request balance. And traditionally, the seller is supposed to send you an accounting statement at the beginning of the year. I think January 31st is the deadline, showing what your balance was previously at the beginning of the year before, and how much you paid and what your current balance is from this year going forward. If you do not receive one every year, then you have a right to request a balance from the seller. So you have a right to deduct. And what this means is that you may offset any amounts it owes to the seller against the amount for which the seller is liable as a result of its violations. Buyer, you do not need to sue the seller in order to offset. And then you do also have a right to cancel the contract for any reason within 14 days of the date of the contract by giving written statutory notice. So if within 14 days of you signing the contract, again, you can cancel it and opt out of the contract, but you do have to give them written statutory notice. So how do you record your contract for deed? Again, and I know it sounds repetitive, but this is very important because you do want to protect yourself and your interest in the property. And I'm going to stress it the whole time I'm talking about this because, again, we do see it a lot here. And then at the end of the day, you've paid all your money and you're ready to get your deed, but the contract was never recorded. So then it becomes a whole big mess and you have to call us and we have to help you if we can. So if your seller doesn't record the contract in the county deeds records, you can then record it yourself. And then to be recorded, it must be the notarized original copy, a certified copy, or be attached to an affidavit as we discussed. So again, if the original copy is not notarized, you can have an affidavit, which you would then have to have notarized, and then stick it on top of your contract and file it in your county deeds records. You can also file it in person at the county clerk's office or by mail. So if you have a copy of the contract, you can still record it, but you will need to include a notarized affidavit concerning executory contract for the conveyance of real property with original executory contract. So in this notarized affidavit, again, this goes to whether your contract was not notarized to begin with. This notarized affidavit must include your name, state that the attached affidavit is a true and correct copy and you're recording it under Chapter 12 of the Texas Property Code. It must also state that this is an executory contract for the conveyance of real property under Chapter 5 of the Texas Property Code. It must include the property address and a legal description of your property. And if you can't find if you don't know what the legal description is, you can also go to the Harris Central Appraisal District's website, type in your address, and the legal description will pop up on a section to the right of the screen. Names of who signed it, which is yours and the seller's, and the date that it was signed. It must also include that the contract was not already recorded, but that you're recording it now in accordance with Chapter 5 of the Texas Property Code. And also, it must also state if the property is your homestead property. So what happens if you default in your contract? So first, the seller must give you a written notice that you're defaulted in your loan, and they must send it to you by certified or registered mail with certain statutory language and give you 30 or 60 days to bring your account current. If you have paid less than 40% of the purchase price or less than the equivalent of 48 payments, the seller must give you at minimum a 30-day period to bring your account current. If the contract is not recorded, then the seller can rescind the contract and evict after 30 days. So again, this is one of the reasons why we stress that you make sure that your contract is recorded in your county clerk's office because they can evict you and not foreclose on you, which is a longer process. Well, the foreclosure is. So, and then if you have paid 40% or more of the purchase price or the equivalent of 48 payments, or you have a recorded contract, regardless of the amount paid, so you don't need 40% or 48 payments. But if your contract is recorded, they must give you a 60-day time period to bring your account back to balance, to bring your account current. If you fail to bring your account current, I know it says cure, but I like to to tell people, that means bring it current. The seller may sell your interest in the property at a foreclosure sale. So following foreclosure, the purchaser at the foreclosure sale may file to evict the buyer. So again, recording your contract does provide you with an extra safety net if you happen to default. Oh, and that was it. So any questions about that? Or let me just go back over contract for deeds again. Remember, have your contract notarized at the signing, if not, and make sure that it's recorded within your county clerk's records. If not, make sure you have your affidavit notarized and signed by you, and then take it with your contract to your county clerk's office and have that recorded to make sure that your interest in the property is recorded within the clerk's records and provide you that legal safety net. Make sure you're getting your accounting statement at the beginning of every year, and make sure that your contract is in a language that you can understand and you can read, because again, we have seen a lot of Spanish speakers who sign an English contract and they don't know what it means, and it's better for you. You're entitled to that. So make sure you ask for that. And then we have also seen a lot of people who say, well, I've paid what I was supposed to pay and it's been 5 years and I can't get my deed. Make sure you're asking for your accounting statement so you can stay on top of that and protect yourself. I'm not saying that these sellers are out to get you, but you do want to protect yourself, because who else can we trust but ourselves? Anyways, any questions?
There was a question that just popped into the chat that says, will a foreclosure, how soon will HCAD show the new owner's information?
Um,
That really just depends on HCAD.
yeah. Uh, yeah. Well, thank you, Sam, for all that information. And I had another tax comment too, so that's great that you asked. The new buyer should report their purchase to HCAD, and then as soon as HCAD has the time to process it, it may take a month or so or two, however long they need, then it will show. But if the new buyer doesn't report it, it's only going to be whenever it shows up in the records that HCAD periodically checks.
First of all, I definitely say before you even get into that particular kind of situation, make sure that you even buy through a title company.
Mm-hmm.
I definitely would not go to giving out money and stuff like that without actually making sure that you're buying the house from the person that says that they actually rightfully own it. So that situation comes up a lot too, where people are into the whole for sale by owner, or kind of a scenarios or what have you, and they don't know that there's heirship issues and title issues, and that or whoever is selling it still has a mortgage on it, because if they still have a mortgage on it and then you're buying it from them, that's a whole nother scenario in itself as well. So never ever ever enter into this kind of an agreement when you're buying property and you're not closing through a title company. I definitely would not recommend that at all.
Absolutely. Thank you
That's
for
it.
pointing that out.
I've also seen instances where we're in a contract or deed and the actual seller defaulted on their property taxes. And so these owners don't know that they're being foreclosed on, and the home that they've been paying into is about to be taken from them because the actual seller didn't keep up with their end of the bargain. But you should
Mhm.
always make sure that your property taxes are paid as well.
Yeah.
I had one of my real estate clients who was kind of had entered into this agreement with this gentleman, and she was making her payments and what have you, and the man ended up passing away, and his wife had no idea that he was actually entering into this agreement with the tenant that they had at the time, and the wife decided she was going to sell the property. So
Yeah.
basically, the young lady ended up getting evicted and put out, and there was nothing she could do about it.
Yeah.
We've seen a
So
lot of
We've
those here
seen
too.
several of those, or they don't, nobody, the heirs, maybe they are being good and keeping up with the contract, but they don't have title clear to be able to give them the deed at the end.
mhm.
Um, and I've seen contracts where it was arranged for the buyer to be paying the taxes and where it was arranged for the seller to be paying them. But if, you're paying the taxes, you can record that deed and use it to apply for your homestead exemptions. And HCAD will show you as the owner, and the tax records will as well, and you'll get your exemptions and owe significantly less taxes. So that's definitely something that should be done as well.
Indeed, indeed.
And
Let's see.
we've
There,
also seen instances where it comes to the end of your payment plan, you made your final payment, and then the owner says, "Oh no, you still have a whole bunch of money left that you have to pay me." And what are you supposed to do because you're not getting your accounting statements at the beginning of the year?
you
And
can't
Mhm.
then,
prove it.
Yeah.
as
Mhm.
much as Houston floods, you lose all your receipts in the flood waters, and whatnot. So then what's your, track record? How do you record or how do you prove that you've paid all of your payments like you were supposed to if you're not getting those accounting statements?
Yeah.
Mhm.
And I will even go a step further that says if you get them by mail, scan them, take a picture, email them to yourself, keep them in a folder in your email. Because again, Houston loves to flood.
Mhm.
Um, and you'll have an electronic record of that.
Yeah.
Hey,
Yeah.
that's what I
And your
just said, Amir.
receipts. Yeah. Yeah, there it is. Yeah, and your receipts. So,
Let's put and Amir Brafoui is in the chat. So he is with Lone Star Legal Aid too. So just know that somebody's not randomly just giving you guys information out there. So let me change that as well.
It's
So
not a stranger danger.
he's not stranger danger. All right. Also, what I wanted to say that we know that, different people, everybody's situation is never the same. No two people's situation is exactly the same as somebody else's. And you may find yourself going the traditional route and getting a traditional mortgage or what have you. You may find yourself being the heir of a property that may get foreclosed on. You may find yourself in a situation where you're doing the for sale by owner. So this is not to scare or deter anybody from whatever their situation is. It's just so that you can kind of be a little bit more conscious and aware of what steps do I need to take, what I need to put in place to make sure that I'm protected, and then knowing where I can go to get some assistance or some help if I find myself in this particular situation. So have these kinds of conversations with people. Your neighbor right now may be going through foreclosure and you won't know it until that sign goes up on that lawn. So, just kind of randomly have conversations with people because you never know who still may be going through some kind of financial difficulties and may need some kind of an assistance with in regards to foreclosure and foreclosure prevention. Don't wait until the last minute when your property is due to be foreclosed on the first Tuesday, on the Friday before Memorial Day weekend, and you don't know what it is that you're going to do. Someone did email a question that was very thorough, that I will not actually address on here, and she goes into a lot of scenario about community property, and the husband is now deceased and what was supposed to be settled and during divorce and all that. Please reach out to Lone Star Legal Aid and apply for their service. That is a little too much detail for us to discuss on this platform where you're going to get the information that you need. So definitely make sure that you reach out to them, so that you can get some kind of legal assistance that you're going to need, definitely. And I'll send their information to you guys to this so that you can kind of be aware of what that question is. So you can kind of be on the lookout for that. There was another question that was emailed to me, so I'm trying to watch all the platforms at the same time. Do, 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 do.
While she's looking for her question, I do want to reiterate what she said. Don't wait until your house is about to be sold at the auction next Tuesday at the foreclosure sale. Call us when you get that certified letter. Um, Maybe there's something we can do to help you. We won't know until we do discuss it with you. But
yes.
even if, I mean, I'm not going to tell you not to call us if your home is about to be foreclosed on sold next Tuesday, but help us help you by calling us with enough time to be able to assist you.
Yeah.
Okay. Question here says, my parents are deceased and the property was left. The probate is in process, but I'm getting mixed information from the attorney and from the mortgage company on when I can actually sell and or buy out the property. What do they do?
That's a very good question. First, I would say on the one hand, definitely apply with us if we qualify. We probably need to look at documents in the probate suit and mortgage statements and all of that. But as a general thought, just um, definitely wanting to be set up as a successor in interest with the mortgage company so that they can tell you specific details. Not unclear to me whether that's happened, but then, yeah, we probably need to know more before we could say precisely what the difference is.
Is that something that can be done beforehand? So that way, if in the event someone does pass away, something can already be on file with the reverse mortgage, for the reverse mortgage to say, hey, this is the person that's supposed to inherit, or this is the person that will be in contact with you guys in the event something happens to me. Can that be preemptive?
That's a good question. So on the one hand, you can have a third party authorized person. You fill out either they have their own special form or you just create your own form and send it in where they will recognize a third party that can talk to them. So that's certainly some evidence before the person has passed. But once people have turned in powers of attorney and such, but once the person has passed, that's no longer valid. So really, they just need to follow the process, which should be submitting their photo ID, submitting a death certificate, submitting something like an affidavit of heirship or probate or will, something to show that they're an heir.
Okay. There was another question, and I'm kind of trying to decipher what the end of it is because it was cut off or she didn't fill in the blank. The mortgage is currently in default. I have a forbearance amount that was offered during COVID. My loan has now been accelerated. Does this mean that in order to, and then she cuts off. So I'm assuming that she wants to know what does that accelerated piece mean once she comes out of forbearance?
Sure. So after the forbearance, they should have given her a length of time, possibly pretty quick, to sort out how she was going to resolve the amount that was in forbearance. So they gave her 3 months or 6 months or whatever. Now a certain amount is due. She ideally could have gone through the loss mitigation process to try and set up a payment plan or whatever, but it sounds like somewhere along the way, mortgage company has now determined that the default is beyond the amount of time and they have accelerated or made the whole thing due. They may or may not have sent that 21-day certified letter saying that they can foreclose. So at that point is when you're trying to first see, can you engage in any loss mitigation? Is it something that you can do to work with the mortgage company to get them to de-accelerate actually the loan and consider you back in getting in current. So that was my first thought. So you may still have options. And then the next one is looking at those non-home retention options, is it time to sell or what have you?
Let's see. Amir says, I agree. I echo Lauren's comments with HECM. That's home equity conversion mortgage. That's also reverse mortgage. Send some documentation, email, online forms, ideally letters to the senders, ideally to the lender, saying something like, this is my authorized representative or contact person in case of my death. This can be sent in using the notice of error process and demand that the lender confirm in writing that they've updated their records and will be the contact person.
Yeah, that's a great idea. And that's right, that if it's a reverse mortgage, they're required to at least attempt to notify heirs. So I don't know how thorough the research is, but gosh, if the borrower has given them in writing all that information, then that should be on file.
I've seen a lot of prideful seniors over
Oh,
the years, and even though you are required to have reverse mortgage counseling before you go through that process of getting a reverse mortgage, if you decide to do that for whatever reason, make sure that you have a conversation with your heirs or you let somebody know what's going on or that there is a reverse mortgage because you don't want your family members to all of a sudden, kind of be surprised and shocked that they're even starting to receive these letters, about a mortgage being paid, payable and due or accelerated and now they have to come up or figure out what they're going to do, especially if they haven't started a probate process or anything like that because that's a real specific timeline. So there is no let me grieve for 3 or 4 months before I decide to, because in the other presentations where we talk about wills and estate planning and what happens after and the probate process, when we're going through all that, we're telling people to take time to grieve. Don't be in a rush to, make sure that you're in an emotional state that you can actually deal, because that's a lot of stress. That is a lot of stress
Hmm.
when you're having to deal with someone's estate and probate and all that other kinds of stuff when someone passes. And you want to take that little bit of a mental break before you kind of jump into that. But in a scenario like this, where you're reverse mortgage or you're facing the foreclosure, you don't have that kind of time to really just sit and wait. So have those conversations beforehand so that somebody knows this is what you potentially up against, or this is what needs to happen. But my question in regards to that, so if someone gets a reverse mortgage and their property, what they actually owe on the reverse mortgage because of interest and all this other kind of stuff that's accrued, if it's not worth what the value of the property is, what's the point of me as the heir going through all of this kinds of stuff to make sure that it's sold or whatever to prevent it from going into foreclosure? If you're going to end up taking it anyway, and I'm not going to get anything out of the property,
Right. No,
just
that's
let
an
me take it.
excellent point.
Why do I want to go through all that?
Well, it's case by case. The example that I referenced earlier, this particular heir had a particular person he wanted to sell to. It was a friend of the family. She was an investor.
Oh,
She could afford it. She would be, reasonable with him about whether to move out or what was going on. It was his mom's property. He cared about it. He liked to know the person who was going to get it. So there could be those kind of, emotional reasons. Um,
mm.
so that's one thought. Um, yeah.
But other than that, there is no benefit if I'm just the heir.
Well,
And okay.
another thing is, if you're on the foreclosure block, you're getting all those, notices. And literally, I mean, I've done home visits and someone's knocking on the door trying to buy the house. If you can avoid all that stress, like you said, it's stressful. You want to take time and all of that. Now you have people calling and emailing. If you could sell it and not have, those things, that's another thought I could have. That might be an idea.
Here's another question that I had, and I know you. I think I recall you saying something about legally they have to wait 120 at least 120 days before they can start the foreclosure process and so on and so forth. Why is it that the lender won't try to eliminate or alleviate some part of this prior to that 120 days? Because I've seen some, being in the nonprofit and real estate and whatever, that the mortgage company won't even talk about loan modification or a short sale or anything like that until they are 3 months, 4 months behind. If I know hours got cut at work or I lost a job, laid off, whatever, I didn't pay my mortgage the first month, the likelihood of me right now finding a job or getting a job where I can kind of get myself into a scenario or a situation, I'm into month 2 right now. I want to try to be a little bit more preemptive to try to get this taken care of before I get to 3, 4, 5 months behind before somebody comes. Why can't they work with you prior to you getting so far behind that you're now even talking about foreclosure?
Right. So that's a really good question. I have some speculative thoughts, but my initial thought is first, like you said, you're being reasonable. You realize the problem, it's your house. Definitely reach out to them, ask for these options, tell them you want to voluntarily enroll, send a notice of error saying, I know I should have options. If they're still not allowing it, maybe they're afraid of running afoul of a law that they're not supposed to be pushing this beyond that, but they should at least be sending notices advising you of the delinquency. And um, yeah, that's a really good question. I would definitely say advocate for yourself and ask for it and tell them you want to engage with that.
I've seen letters too from mortgage companies to our clients that say, hey, you're behind. Starting at the beginning, call us. Let's talk about it. Here are some options. Fill out this form. But a lot of times our clients say, well, they know they don't have the money to pay it. So out of sight, out of
Mm,
mind, we're not going to pay attention to it because a lot of times it's overwhelming. It's very overwhelming when you're behind on your bills and you know that your home could be taken from you. So out of sight, out of mind again, let's ignore it until they're knocking at your door saying, hey, guess what? You know, your
Yeah.
home's being sold next Tuesday. But sometimes they do offer it. I've seen a ton of letters to know that they do, but again,
Hmm.
sometimes we just d- don't know what to do.
Yeah.
So you
Or
need
just,
to ask, basically.
yeah.
Ask them.
Ask. Yeah.
Communicate.
Yeah.
Communicate. Let them
Yeah.
know. Okay.
Yeah. And
Um,
Amir had some thoughts about maybe the lender or mortgage company isn't doing that great. Maybe ask for somebody new or send that notice of error like we talked about.
uh, Another tool is to force the lender to offer your loss mitigation by sending it a notice of error demanding the opportunity to uh, be evaluated by loss mitigation. But then at that point, do you still have to wait until you're 3, 4 months behind before you can force that issue or before they can legally do that?
That's a I mean, I can't think of a legal prohibition. I think it could just be, you know, like was mentioned, we have some loan servicers who are on it and we call them and we know we're going to get the information we need and they're going to keep their records and they know every time we call that we're the authorized representative. And then we have some that seem a little less organized. So that, you could just be encountering that human error type of issue. But if they have it in writing that you're asking for it, then they're actually required to review and investigate and tell you what your options are.
Okay. So assuming that out of sight, out of mind, I'm overwhelmed. I don't want to talk about it. I don't want to deal with anybody. From the time you are behind to the time you do nothing and it goes to auction, what's your timeline? What kind of time frame realistically at a minimum that somebody is actually looking at from when they start foreclosure to when the house is gone and you're evicted and all of that? What's your timeline?
That's a great question, because that requires math.
And she's a lawyer because she's
Theoretically,
not good at math.
yeah, exactly. So no, I'm thinking, the 120 days behind, then they send the 20-day letter, and sometimes they give them a lot more than 20 days.
Mhm.
But let's say they stick to that precisely, and then the 21-day letter. So however many, days that is, what is that looking at? Maybe 6 months
41,
ish,
121,
6 months.
plus,
161 days.
plus the 120. And then foreclosures can go, I mean, evictions can go pretty fast. So that's another, you know, month or two max, in my opinion. But again, these are all don't, hold me to the precise deadlines. But in other words, it's a fairly quick thing. And like both of you mentioned, people are dealing with a lot. I don't think I've ever seen anyone who's behind on their mortgage who isn't also behind on all sorts of other things and having all sorts of other traumas going on in their life. So even if objectively, oh, 6 months sounds like a lot of time, it's not a lot of time when you're facing all these numerous challenges.
But for someone who, you can't say out of the blue, I
Yeah,
you had at
you had
least
some notice,
months,
yes.
ish to kind of figure not figure it out, but at least kind of start to come up with some other kind of plan. If I know I'm not going to have this money, don't wait until you're 6 months in and now you're trying to figure out where it is you're now going to live or where it is that you're going to go because you're looking at max would
Yeah,
say on the at minimum at least a 6 month time period from the time that you end up in foreclosure to the time that you're gone,
yeah.
at least
So
6 months.
yeah, so putting your head in the sand usually isn't the best solution for any
Yeah.
problem in life, and I tell myself that too. But so yeah, looking for your options. People sometimes, because they don't have, the cash flow, they don't even know that they have options. For example, if they have an FHA loan, they may have the option to do a partial claim where they're like, you know what, I know you're 10 grand in behind. We have a special investor right to let you just stick that at the end of the loan and start fresh now that you have your new job. They don't even assume they just think I've got to pay that whole thing back. I have no option.
Mm-hmm.
Maybe there is a chance. So again, talking, communicating, having them see records that you've been trying. There may be options you don't know about, or at least if you don't have options, at least it's not, slamming you out of the blue. You at least have some time to think and plan.
Mm-hmm. Okay. All right. Well, again, communication is key here, and in responding to things in a timely manner in order to prevent this from happening. But know that you do have rights, you do have resources that are available to you, like these legal service organizations, like Lone Star, that you can reach out to, like housing counselors that can help assist you with going through this process. So um, again, you guys don't know if your neighbor, your coworker, or somebody else may also be experiencing this or have questions about this. We ask that you do share this information. Some other resources that were talked about, different websites, HUD counselors and things like that will be sent to you guys along with the recording of this presentation and the schedule for the next couple of um, foreclosure workshops that we have in case you have questions about HOA foreclosure. We're doing that one next month on the 24th, I believe, 24th of April. I believe that's the fourth Thursday.
Let me see.
Yep, April the
Okay.
24th will be the HOA foreclosure. So if you're people, I've seen these things on couple of different social media sites that these HOA foreclosures are getting to be a little bit out of control and people are losing their homes for what's going on. But know that you've got rights there as well. So you definitely want to tune in to get that piece of that information. And we decided to Amir primarily decided to kind of break these foreclosure things up because it is a lot. It's a lot of different types of foreclosures and the processes and things are different for each one. So it's too much to try to compound into one presentation, which is why we again decided to kind of divide it up and go at it at this rate. So that way you can kind of get a little bit of information, can spoon feed you a little bit of information at the same time, as opposed to overwhelming you even more, especially if you are facing foreclosure right now. We don't want to compound you with
Mhm.
so much information that you can't kind of think straight. And again, by no means are we expecting you guys to be the attorneys by the time you leave here, which is why we're urging you to reach out to legal service professionals that know what these codes and things mean. Because as you guys are giving these statutes and numbers, I'm like, say what now? Like, I'm supposed to know this. I'm supposed to write this down. Do I need to know this or whatever? So we don't expect you guys to be experts. Feel free to come back and watch the live presentation. Go back and watch the videos so that you can kind of get yourself a little bit more familiar or be able to know where to refer somebody to. So also, if there are any presentations that we don't currently offer that you guys may be interested in, if there's some other information that's pertinent to what's going on with you and your family or people in your neighborhood, then please reach out to us and let us know. There's a survey link that's going to pop up at the end of this Zoom meeting. So we asked just to kind of give us your feedback and let us know, if the information that was provided here today, if it was helpful to you, if it had any kind of impact on you whatsoever. If you want to share your story, give your testimony, or just say, hey, this was great. I loved it, or you know what, it could need a little bit of work. Just let us know. Your feedback would be awesome for us. That's the only way that we know how to continue and how to plan and move forward. So please provide us with your input. So with that being said, Sam, you guys did great. Lauren, you guys did great. Amir, thank you for sidelining for us in the chat and kind of feeding us information. Um, uh, Thank you guys very much. We hope that you all again got the information that you needed here today, and you did get the information that you wanted, and it was beneficial to you. So we hope to see y'all next time. What do we have coming up? Oh, that's the end of the month. You guys are the last ones. So next week we've got our Money, Health, and Wealth presentation about credit that's coming up on Tuesday. And then on next Thursday, we have our wills and advanced legal planning. Be a little preemptive of what you need to do to kind of plan and prepare prior to someone passing and kind of, what needs to be put in place to protect your assets and your generational wealth. So tune in for us for next week for that. But if you guys have any
Okay.
questions or anything else, without further ado, I think that concludes our presentation for today. You all have a wonderful remainder of the day. Try to stay dry. It's
Yeah.
it's kind of pretty wet out there. Stay safe, and we will see y'all next time.
Okay. Thank you for having us.
All right. Thank you.
Bye.
Thank you, Francis. Thank you, Alma.